Hi everybody, I'm Gina Bovin
And I'm Bill Bernaducci.
from Bovin Wealth Management Group. Thank you so much for tuning into our vlog. Today is Friday, TGIF, October 30th, and we're here to talk to you a little bit about the market and the election. It's been a very busy week and it's been a very busy year.
Yeah,
It's
it's snowing.
yeah. It's snowing in Boston, and that kind of sums up the craziness of 2020.
It's true.
Yeah, let's talk a little bit about what's going on this week. We're starting to see some stock market volatility.
Well, there's sort of three reasons why we're seeing the market be a little volatile. The first, obviously, is this raise or the surge in COVID cases. The second is the delay in the stimulus bill, which the market is anticipating, and that hasn't come through the pipeline yet, so we're waiting on that. And the third is this election uncertainty. And so we're here today to sort of review that third factor predominantly.
Yeah.
But we'll go through it.
I'm going to talk a little bit about earnings.
No predictions, though, for the
Yeah,
election.
no. So, we have been expecting some volatility. If you've seen some of my other interviews, generally history shows us before a presidential election, leading up to an election, we do see some volatility. But once that volatility is lifted, we see the markets generally rally.
Right. And October, in particular, has been a notoriously volatile market in an election year. So if history proves out, what happens is after we get through this October volatility, the market gets certainty with a president-elect, and November and December generally experience rallies and an uptick in the market.
So if you take a look at the slide behind us, you'll see this is the average of what the S&P 500 has performed in an election year. I think it's important to know a couple of things. Clients tend to think that if their candidate doesn't win, the market's going to go down.
Right.
And that is emotional investing, which is not a good thing to do, right? You never want to let your emotions get the best of you when you're making long-term decisions.
True.
And another point I want to make is we've had more questions on how the impact of the election on the market than the pandemic. And you would think that clients are used to an election, or investors are used to an election by now, because it happens every 4 years. And a pandemic hopefully only happens, once in your lifetime. But the main concern has been about the election.
True.
And the main question is, who does better? When do the markets do better?
Well, the answer to that is there's no party that holds the title to the best economic performance for whether it's Democrats or Republicans. As a matter of fact, the truth is the economy likes, or the markets like, a split Congress.
Right. So it's really not whether it's a Democrat president or Republican president.
That's right.
Really what drives, or we can look to history and show that the market likes gridlock.
Mm-hmm.
So if you look behind us, you'll see that when the Republicans have been in the majority in Congress, the market has done about 13%. When it's been Democrats, it's been almost 11%, and when it's been split, the market has averaged over 17%. So I think after this year, any of those numbers look good.
And I think that gridlock, while it's not good for governance, right? It's certainly good because it takes the politics and policy out of Washington out of the market. So it enables, the economy to run without being restricted by certain policies on either side.
Right. Let's talk about some of the winners under a Biden administration, and then we'll talk a little bit about the winners under a Trump administration.
Fine, we'll do the scenarios under both administrations. No predictions, but
No.
we'll do the scenarios under both. So winners under a Biden administration are obviously, infrastructure. The policies that have been part of his campaign are to raise taxes, but that will enable more money to be spent, in budgets federally on bridges, roads, etc. So that's a big winner from Biden. The second winner from Biden is renewable energy. So your wind, your solar, your electric vehicles could see an uptick from a Biden administration. And the final is trade policy. So if you're looking at the trade tensions currently with China and tariffs, those could be rolled back under a Biden administration. So you can you could possibly see some increase in emerging markets like China in particular, or even in the EU and European Union, as we're pulling back from a lot of these trade tensions that came around.
Europe's having a tough time though.
They are.
Yeah, you know, so, but we do like emerging markets and China specifically. I think one of the concerns I have is, you know, taxes going higher under a Biden administration, and that is a concern. Um, so it's, you know, estate taxes, personal income tax, capital gains tax, corporate taxes.
You know, taxes will rise under a Biden administration. I mean, that's literally been part of his platform. Nonetheless, you know, as taxes rise, there is a sort of a light at the end of the tunnel because you're going to get greater government spending. So
what you're saying is hopefully that will make its way back into the economy.
That's right.
Yeah.
And some of the beneficiaries of that government spending, you know, if taxes are raised, would be, you know, infrastructure again and healthcare. Mm-hmm. That could be you know, buoyed up a little bit by a little bit more government spending, which does provide a stimulus to the economy. So
right.
more government spending. Consumer spending obviously is more impactful, but government spending could help out also.
So the concern with taxes is really corporate earnings. So
right.
if you think of a company like a business with the budget and expenses
right.
are going up, then earnings you won't be as good, and that's one of the main drivers of the stock market is earnings. But you have a counterpoint to that.
Well, even if corporate earnings are decline as a result of higher taxes, you know, the Biden plan, which would enable China, you know, those tariffs to removed from China. When you factor in the tariffs getting removed, it actually doesn't, you know, it offsets some of the tax impact. So it's still impactful, but less than people consider, I guess. So okay, that's a good point. I want to talk about the winners under Trump, like what's going to do well in the market, you know, should President Trump win. Mm-hmm. And I think we're all going to be up late watching the election, but winners under a Trump victory would be energy, defense, aerospace. Specifically, though, it'll be a continuation of the same because President Trump has a very pro-business agenda. You know, we'll see continued lower taxes across the board, especially for companies. We've seen 150 new stock market highs in the last 4 years. That's right.
You know, it's really been remarkable. The financial services sector will see more deregulation with banks. I think if Biden is in the White House, we're going to see more regulation with financials and investment companies and banks. He may even have Elizabeth Warren in charge of that, and I think that there's definitely going to be a crackdown on a lot of regulations. So
another factor that helps, you know, the incumbent is that the stock market does tend to do better when an incumbent is reelected.
Yeah, that's kind of easy to explain. The reason is because if the economy's doing well, the incumbent is reelected. So what came first, the chicken or the egg, right?
So a strong economy can usher in a reelection of the current administration, and then that you know, a strong economy can just continue on through the remainder of the 4-year term.
So, on average, the economy does significantly better if the incumbent wins re-election. But if a new president is voted in, the market average is about 5%. If the incumbent is re-elected, I think it's over 9.6%. So
So some takeaways
Yeah.
that, in terms of an election analysis, whether it's a Democrat or a Republican, I mean, the president and who's in the White House is a factor in the economy, but I don't think it's the
No.
predominant factor. I think if you looked at some of the fundamentals of the economy, you look at corporate earnings, you look at interest rates, consumer spending, those are the real factors that drive the economy even more. And I think people think of that a president has more control or drives the economy really more than he does.
Yeah.
So,
Well, we're in the middle of earnings season, and right now, 85% of the companies that have reported earnings beat their estimates. So it's really not that bad, but I think right now there's just not a catalyst for investors to add new money to the market. Um, and I think that's really what's going on. I think COVID is going to drive the market, but all of this is short term. We're looking into 2021. We believe that we've turned a corner with the economy. We are going to see some stop and starts. This is really similar to a lot of other recessions where there's going to be winners, there's going to be losers. People and companies are going to have to reinvent themselves, but this recession is different because we've caused it and we shut it down. When we reopen, and we will reopen, the market and the economy will recover, and it's just going to take some time, like every other recession. So it's very important that you not let short-term volatility, emotion, knee-jerk reactions, and panic drive your long-term investment decisions.
I think that's right.
Yeah, and go
I
ahead.
think you want to think long term because your retirement planning, your investment objectives, and your investment strategies, they're going to last a lot longer than a 4-year election cycle or an 8-year presidential term. So you have to take into consideration a little perspective, also an understanding that presidents don't impact the market as much as we think they do, although we do get sort of very passionately tied to our candidate of choice.
So those three things: earnings, we talked about. It's a great earnings season. Consumer spending and retail sales, which have been strong. They make up 70% of the economy. So that's, to me, more important or more impactful to the market than who's president. And interest rates. Interest rates are low and they're going to remain low. And this is important because if people aren't getting any return on their cash, eventually that money's going to have to make its way into the market. You have to stay ahead of inflation. And if interest rates are at 0 or even 1%, you're going to have to invest in some type of stocks or bonds, probably mostly stocks, in order to get growth. So please call us if you have any questions. Anything else that you want to add?
I would just encourage you to vote.
Yeah.
And if you haven't voted by mail, feel free to go to the polling stations and vote.
And this is the first time I've said this, but we hope you have a happy Thanksgiving, a safe Thanksgiving, and a happy holiday season. So please call us with any questions, and thank you for tuning in.
Thank you.